Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, June 2nd, 2022, and I am pre-recording this Trading Places Live for just a bit later this morning. Currently, futures are pointing higher. We've got the Dow Jones futures up close to 150 points, S&P 500 futures up more than 21, NASDAQ futures up 84. This can change, of course. I've still got a couple hours before we get to the opening bell, but at least for now, it looks like we're going to get off to a good start. Historically, this is a good time of the year. Usually the last week of May through the first week of June tends to be very strong. So far, that has been the case this year. New money coming in at the beginning of June. At the end of May, you've got money managers, portfolio managers, hedge fund managers, those types, buying ahead of the money flow. That's typical most months of the year, and we're seeing it again this year. How long it lasts? Well, we'll see. I'm not overly convinced that this is the bottom, the ultimate bottom, although I do believe we are close if we're not there. But we'll go through some charts and see where we stand. Before we get into any of this, though, I'd like to bring up today's agenda. So what we will do today is we're going to go through that daily market recap with you. So we'll go through all of Wednesday's action. Then we'll go into talking technically, break it down. I'm going to look at the energy sector today. Then we'll do earnings spotlight, and we'll wrap up with the 3 you must see, including 3 Dow stocks. One in particular, I think, could hold the key, or at least one of the keys in the near term. So you don't want to miss that. Before we start the show, though, let me take you over to earningsbeats.com. Those of you who've been following me for a while are probably aware of this, but for those of you that are fairly new, I'd love to invite you over to our home at earningsbeats.com. If you scroll down, we have a free newsletter, Earnings Beats Digest, which is published 3 times a week, Mondays, Wednesdays, Fridays, usually out by about 8:30 in the morning. So it's about an hour before the market opens. All it takes is a name, email address, and hit the subscribe button. There's no credit card required. You may unsubscribe at any time, no questions asked. It's really just out there to show folks some of the things that we look at. So we're going to focus a lot on earnings and relative strength, candlesticks, price volume, trend lines, all that kind of stuff. So and it's a very quick read, by the way. Normally just 1 chart and 2 paragraphs. So probably can go through the whole thing every morning in about 2 or 3 minutes. But it just gives you some food for thought about the market, about individual stocks, could be a trading candidate if you're interested, that sort of thing. Anyhow, just go to earningsbeats.com, scroll down, you'll find that right there. All right, let's talk a little bit about what happened on Wednesday. So for the daily market recap, let's take a look first at the Dow Jones. Dow Jones down 177 points. S&P 500 down 31. NASDAQ down 87. Mid caps down 20. Small caps down 4. All the major indexes down less than 1%, but all of them down more than 1/3 of 1%. So kind of all fit in that one general area. The one thing that I do like, every time the market seems to get any kind of a bounce, it normally comes with a rise in the AD line. I mean, you can see the Dow Jones actually breaking to new highs on the AD. That tells me that this move to the downside is likely being accumulated. And that gives me just more reason to believe that this is a cyclical bear market in which we will rebound when it comes to its conclusion, I believe, at some point this summer, where we could have already hit it. That could have been it in May. I believe we probably have one more leg down. We want to be careful, especially if we get back through that 20-day moving average to the downside. We'll have to just kind of play it by ear, play it 1 day at a time. I know there's old cliches, but it's really the truth. We just got to see how this market plays out. But I do like the AD line breaking out on the Dow. The S&P is not far from breaking out. The NASDAQ, I mean, if you look at just the lows in price, see all these lows coming down, lower lows, and look at the AD lines, higher lows, higher lows, higher lows. even mid caps, higher lows, small caps, higher lows, as prices keep going down. I find that to be just, I mean, it's just one piece of the puzzle. It's just one signal, but I think it's a big one. We'll see whether or not that, it pans out, but I think it's a pretty big deal. Anyhow, as far as sectors go yesterday, energy, that was the big one to the upside. And energy has been our leader. As I mentioned, we're going to break it down a little bit later in the show. Take a look at just how different components, different areas of energy are looking, and maybe how you can look for individual stocks. Hopefully we'll have enough time to get through all of that. Anyway, energy up 1.6%, but just about everything else was down. Financials down 1.6%, healthcare 1.4%, staples 1.3%, communication services 1.15%. I don't see technology on this list. I don't see consumer discretionary on this list of areas going down. That's why when we went down, it was only down 1/3 of 1% to roughly 1%, all in that area, because the key heavily weighted areas like technology and consumer discretionary actually held up pretty well. So that's another good sign. We want to see that continue. Relative strength in those two areas would be very, very helpful as we try to carve out a bottom. 10-year Treasury yield. Well, get to this in 1 second. I do want to just go over economic reports due out today. Of course, we have a really big one in the ADP employment report. That will be coming out just a bit later this morning, 8:15 a.m. Eastern. And we are currently expecting 240,000 jobs to be announced. Last month was 247,000. So we are looking for a slight decrease there. I'm not sure what the market will do if we come up, with a big miss, kind of like we had on the GDP when the GDP was expected to be positive and then it was negative. I'm not sure. I don't know how the market would react to that. I don't think the market would react well because, you've got rates continuing to be hiked. So I think this is kind of a big deal. We'll see. I mean, the bigger report's going to be tomorrow morning when non-farm payrolls come out. Also later this morning, initial jobless claims, that'll be at 8:30 this morning. Last week, 210,000. This week, expected 210,000. I don't know how many weeks in a row now. I'm going to say maybe 4 weeks in a row that we've had disappointing news from jobless claims. They've been higher than expected. So watch the 210 level. Missing on the jobs, and then also, missing on the ADP employment report, and then also missing on jobless claims would not be a good combination. So we'll certainly, I'll be looking at that this morning. Factory orders will be out later this morning. I think that's due out at 10 a.m. And factory orders are expected to increase by 0.8%. However, it's an April report. So here we are, the second day of June. We're looking back to April for factory orders. So looking in the rearview mirror, I don't know how much impact this report is going to have. For what it's worth, March increased 2.2%. So the April report at 0.8% is expected to be a rather big drop from what we saw in March. Again, I don't think it will be a big report in terms of how the market reacts, just because it's in our rearview mirror so far. Stock market's more worried about what's going to happen next month and the month after and the month after that, not what happened 2 months ago. So I think we'll probably get a fairly muted response to that report at 10 a.m. unless it's a wildly crazy report where we have a big miss. All right. Let's see what else. Well, I mean, looking at the 10-year Treasury yield chart, we went down. We got that reset. Got the 50-day test. This is what I expect right here. This is just a poster child of what I look for when I get a negative divergence. There's your lower PPO. Here's your higher price. There's your reversing candle where the yield gapped up in the morning, came back down, closed below the prior day's candle body. That is a reversing candle, negative divergence. Started talking about it then, expected decline, probably, down to the 50-day moving average. Look for the PPO to work its way all the way back down to the center line for a reset. And that's what we got. And now that we got it, here come yields back to the upside. So I think we've established now our key low, which is down close to 2.70%, and the high, which was 3.16. That, in my opinion, is our range. I think it would be very bullish for the market if the 10-year Treasury yield were to go back down below 270 at this point. I think that could be a signal that the bond market is no longer fearing inflation and it's more concerned about a possible recession. That would be my initial reaction. Let's just say that. If we go back below 270, I'm going to be looking for other signals that would confirm that notion. Now, if we keep going back up, remember, I think it was 2011 was the last time we went through 3.25% on the 10-year Treasury yield. So if you think, if there's something that might really spook the market, I think it would be the 10-year Treasury yield breaking above 3.25. So we're back to 293. Yesterday, we were up 9 basis points. This morning, I think the last time I looked, the yield was down a couple of basis points. Yeah, down 2.5 basis points, 2.91%, just below 2.91%. So we're still kind of in this range. Let's see what happens. Again, below 270, I would be looking for corroborating signs that perhaps we have a market bottom in the stock market. If we break out, that will be very interesting to see how the stock market reacts to. So I think this is going to be a key chart to watch. All right, let's move on talking technically. I wanted to show you first the S&P 500 here up on the top. Let's make this chart a little bit bigger. All right, so here's your cyclical bear market, top to bottom. We now have a 20% move. So anybody who was thinking, well, it wasn't a bear market because we didn't have 20%. Well, that puts that argument to rest. I was talking about bear market at the top, that it was very possible we were going to see a cyclical bear market before we started going down. And we got it. I think the rest of the market, pretty much, we knew it back in February and March. We were already hitting some pretty big moves, percentage moves to the downside. But it took the S&P 500 a little while longer to catch up, mostly because the large cap growth stocks held up for so long. But I think once the market started thinking recession, I think that's when everything changed for all growth stocks, but especially the large cap growth stocks. Many of those names, Apple, Microsoft, they have pricing power. I don't think they were worried about temporary inflation issues. As far as recession goes, though, that just means less consumption. We're talking about negative GDP. That affects everyone. So I think that's what the market is more concerned about going forward. I think it's more about the potential recession and the hiking of rates while we're already showing a slowdown. So again, 10-year Treasury yield breaks out to new highs. That could just be another leg lower in the S&P 500. But it'll be very interesting if we do that. If we do see the S&P go back down, challenge this low, or even break below it, it's going to be very interesting to watch the relative strength of all the sectors. That's going to be the most important thing that I'll be watching. Without a doubt, the most important thing. I want to see how the rotation is on the next move lower, if we have one. The equity only put call ratio, this is a 5-day moving average. I just wanted to point out that it reached its lowest level in about 5 or 6 weeks as of yesterday, the 5-day moving average. So all of a sudden, we've had a little bit of movement to the upside, and folks are right back in on the call side. That bothers me a little bit. I'd like to see this sentiment reading take one more big move up to the upside. I'd love to see this go up to 0.80 on a 5-day moving average basis. I think that would probably help us to mark the bottom if we haven't already marked it. 0.75, I think I talked about this on one of my shows, and I went back and looked. And since year 2000, I pointed out what I thought were the 18 most important bottoms. So all the significant bottoms since year 2000, 18 of them. 15 of them we saw the 5-day moving average of the equity only put call ratio hit 0.80 or higher. The other three, we saw the bottom form when we hit 0.75. Well, this one hit 0.75. These two bottoms right here came in at 0.75. So while I'd feel better about it going above 0.80, we do have a little bit of history of bottoms forming when we've gotten to 0.75. And we were coming from a very, very low level, much lower than at any other point in history. So maybe 0.75 is all we needed, but I'd feel better if we got this back up to 0.80. So one more big drop, potentially get a lot of fear in the market to say, okay, we're never going to find the bottom. It's never going to be over. That could coincide with more inflation news. It could coincide with the Fed being more hawkish. And that could be a problem for the market. And maybe we go back down one more time. But I think if we do, we're going to see that sentiment reading get to a level that'll be to a point where I believe it'll mark a major bottom as we go forward. In a perfect world, I'd like to see all that happen either in June or maybe even as late as September. So I think the next couple of weeks to couple of months are going to be really important for the market. If we haven't established a bottom, I think we do then. All right. Further down here on the bottom is the VIX. So this is a 5-day moving average of the equity only put call ratio. This is just the daily reading. And what I want you to focus on here is that we're back down to about 25 and change. And if we get off to a good start today, again, futures are higher, then it looks like maybe the VIX could move to the lowest level we've seen in the last 5 or 6 weeks, same as the 5-day moving average. Now, eventually in a bull market, you want this to go down. You want it to go all the way down. So is that what's going on now? Or are we just getting a little bit ahead of ourselves on this move to the upside? If we come back down, break to new lows, I think you'll see both of these sentiment readings move back to highs. And that is what would be necessary, in my opinion, to really and truly mark a bottom in the market. We'll see. Still got a lot of action ahead for sure. All right. What else did I have here? Oh, I wanted to just show you quickly the XLK. So here was a double bottom on the XLK at about 141, 142. Here was a bottom right around 140. Here's the 50-day moving average, 145 and change. I think this 142 to 140, or actually 140 to 145 area, big support on the way down. I think that's going to be your big resistance on the way up here. So we've gotten through the 20-day. Watch some of these key sectors, watch some of the key industry groups, watch some of the key stocks, some of the big technology names, Apple, Microsoft, those that have gotten back above the 20, watch to see if they can hold the 20. An uptrending stock or sector or market, whatever, when it starts to uptrend, pullbacks generally hold the rising 20-day EMA. So if we're thinking, okay, the bottom's in, we're starting to make a move back to the upside, we should be looking for support at the 20-day. Now, ultimately, we need to get prices above the 50. We need to get the 20-day above the 50. And then we need to continue to see that 20-day holding. And that would be an indication we're completely out of the woods. You can see on the chart, we still got a lot of work to do here. But the XLK is something I'd be paying attention to. And also down here at the bottom, look at the relative strength. See that double bottom right here? You don't want to lose that. And we are still in this downtrend, this relative downtrend, even though we have seen a bit of relative strength recently. We've done that before. We saw that in March. We saw it in April into early May. We saw it right here at the end of January. And each of those instances, it resulted in more relative weakness to follow. So is that what we're going to see here? Watch that those relative lows. The other one I'll show you here is consumer discretionary. So consumer discretionary, big bounce, but keep in mind a huge drop prior to that, huge drop. So yeah, the rebound is nice, but is it just a dead cat bounce? Can we hold that 20-day? It looks like, again, with futures, we're going to have a pretty decent start. We'll see. Relative weakness, we already broke to new lows. So we're getting a little bit of a rebound. The overall trend here is down, not out of the woods. You look at the absolute price chart sometimes and you think, wow, here we go. This is awesome. just letting you know, trying to keep it real. And this is coming from somebody who really likes to be bullish. I think the market, well, I know the market goes up a lot more than it goes down. So I want to switch over to that bullish side, but I need to see more. I need to see more. Look at the volume on the XLY on this bounce, half of what it was on the way down. That's not good. You look at the XLK, go back to that chart, same thing. Look at the volume here. What is it, 6, 7, 8 million? On the way down, we had some 20 million days, 18, 17 million. Again, half the volume on the way back up. Not exactly, giving me the warm and fuzzies, about this market going straight up. All right, let's move on to break it down. So here I just wanted to show you energy continues to move up. The relative strength of energy, very strong, near its high. It's been incredibly strong throughout 2022. If there's one other chart maybe to look at, it would be the price of crude oil, which you can see is really trying to get above these tops around 115. Had a couple intraday moves above. Today it's pulling back, so maybe these are failed breakouts. Perhaps we go back down, test that 20-day around 110. Currently, oil down $3 this morning to 112. So maybe we get back down to that 110 level. Watch the trend line and the 50-day and the recent low. I think this uptrend right here is still in play as long as we stay above about 103. 103, I think if you connect these trend lines, probably is right about there. Your recent low is 103. That's something I would be looking for to the downside for support if we get there. But if we break out back, and confirm a move through 115 and go up and challenge this 130 level, and the 10-year treasury yield continues to move up, and we got a Fed meeting coming up, we got more inflation reports coming up, these are the things that could drive the stock market down one more time. All right. So looking at energy and the various industry groups, I'm just going to walk you through this, a 3-year relative chart. So this is a chart of pipelines relative to the S&P 500 over the past 3 years. And you can see all the way to November of 2020, it was falling like a rock. Went kind of sideways, showed some strength in 2021, but it's really been 2022 with the war, with the spiking oil prices. That is what's driving a lot of these energy industry groups. So there's your pipelines. Here's your absolute chart showing a breakout above these prior highs, and there's your relative strength. As I go through these, here's coal, relative strength. There's your easy break. I mean, that was a huge move up in coal this year. Exploration and production, look at the relative strength. I mean, it is just hardly pausing this year, just continues to power forward. There's your absolute chart, another great looking chart. Then you've got integrated oil and gas. Again, relative strength. There's your absolute strength. And finally, oil equipment and services. Relative strength, absolute strength. So there's no slowdown right now in energy. This is a great place to trade when you get pullbacks. Oil prices are down. Maybe you might see some stocks moving down in these spaces to 20-day moving averages. That would be something to look at. One thing that I would just point out from an individual stock perspective is if you go over, sometimes what I like to do is look at the scooter reports. And then you've got large cap, and notice it's in the order of total of scooter. Look at all the energy names at the top. The scooter, StockCharts technical rank, is StockCharts' version of relative strength developed by John Murphy. I think it's a great way to look at relative strength over the past 5 to 6 months. That's the key limitation on the scooter. It only goes back 5 or 6 months. I just showed you on all those charts how we're now through 5 months of this year. 2022 has been huge for energy. So if we're only looking at the last 5 months, well, that's why you're seeing energy dominating this leaderboard. Energy, 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 all the way down, just energy. Okay, so keep that in mind. Now, one other thing you can do is look for changes. And what I would maybe do, this is showing you all the big changes to the downside. What you could do is maybe do like a 1 week to see what the big changes are. And then maybe pull up energy, type in energy in the search box, and it'll give you the energy names that have dropped the most in scooter rank over the last week. So if you're looking for energy and pullbacks, this might be one way. Now, if you look, I've typed in energy and many of these are coming up utilities. So you might have to scroll down. Here's one. So you got PBR, integrated oil, still 96. You're not going to find too many of these that are lower, that have low scooter ranks because energy's been so strong. It's going to be a rising tide lifting all boats in the energy space. But anyway, this is one way. Now you can also then flip this and go to mid caps. Mid caps percentage or the scooter change, again, energy. And you could change this to maybe an area in energy. Let's say pipelines. Okay, so you could just type in pipelines. And here are the pipelines that have had the biggest change over the last week. Let's just look at one. It's been going sideways, recent lows down around 28.5. Definitely not one of the better energy plays, but recent lows, 28.5. It's been in this 28.5 to 30 range. So if you're a short-term trader and you can get it at 28.5, maybe you get a buck out of it or $1.50. For those of you who like to trade, that would be something to at least consider. All right, earnings spotlight. Some really good reactions to some of the earnings that came out last night and this morning, by the way. If you didn't see, Veeva Systems, they reported, this is in the software area, they came in 99 cents versus 92. The stock's up 4.7% this morning, last time I looked. So Veeva Systems, I think up around $7 or so. It's got to get through the 50-day, so this could be a gap, and I call it a gap in crap. I don't know. We'll see whether or not we can sustain it through the 50-day. If we can, that would be great. If not, be careful. MDB, another software company, big move down. Stock is up 9% pre-market. They were expected to lose 10 cents. They had profit at 20 cents. But, it's up 20 some bucks, 22, 23 bucks, which takes it up to about 260 and change. 20-day moving average is at 264. So again, it could just be a gap and then failure. Just be careful. The biggest one that I saw percentage-wise to the upside was Chewy. Now, Chewy's been beaten up badly, but it's 18.5% higher with its earnings. They beat. Expected to lose 12 cents. They actually had a profit of 4 cents. Will it matter? We'll find out. All right, the three you must see. Let's wrap this up. Dow. This is one of your Dow stocks, Dow Jones component stocks, Dow Holdings. Nice uptrend, sideways consolidation. Watch for a breakout above 70. I think this one looks pretty good to me. Nike been beaten up for a while. You had recent low there at 117, here around 121. We're getting up into that range, 50-day just above. This is an area you want to be careful. Watch Nike. If we do go back down, watch that AD line. Maybe the AD line continues to be strong. And then the last one, and I think this is the biggest one to watch, Apple. There's your bottom right in here at 150, 151. Look at where we're failing right now, 150, 151. If we do continue to sustain this rally, I think Apple could go to its 50-day or maybe close. Watch this trend line as well. Failure here, though, would be really big. So if we fail and we go right back down and close below the 20 on Apple, wouldn't be good for the overall market. Anyway, that's a wrap for me. Appreciate you tuning in. Next Trading Places Live will be Monday morning over at earningsbeats.com. So if you go over to Earnings Beats after 8:45 in the morning, just click on that Trading Places link and you'll be able to come into the room to watch. Have a great day. Enjoy the rest of your weekend and be careful out there. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.